Hello, and welcome to Kathmere Capital Management's first quarter 2021 Market and Economic Update webinar. I'm Nick Ryder, the Chief Investment Officer here at Kathmere Capital Management. During today's 15-minute or so fast-paced webinar, we'll look back on the fourth quarter as well as the year that was in 2020 from an investment perspective. We'll touch on market performance as well as a few topics and key themes that are likely on the tops of investors' minds today. Diving in, we'll kick off with a brief summary of market performance during the quarter as well as the year. We can see that fourth quarter U.S. stocks and stocks really around the globe ended the year in style, gaining north of 10%, 12% returns there in the case of U.S. and nearly 20% in the case of emerging markets, with developed international stocks falling slightly behind their EM counterparts with a return of 16% for the quarter. High yield bonds up nearly 7% on the quarter, and broader investment grade fixed income bonds up ever so slightly less than 1% on the quarter. See 2020, quite the remarkable year for the U.S. stock market, finishing the year up 18.4%. Really a roller coaster ride, as many of you likely remember. Started the year up 5% during the first 6 weeks of the year, followed by that harrowing 35% decline, ultimately the year concluding with a 60% plus rally to finish the year at all-time highs. International stocks up nearly 10% for the year, and EM stocks ever so slightly trailing their U.S. counterparts, up 18.3%. Good year on the whole for high-yield bonds, up 7%, and investment-grade fixed income. Intermediate duration up about 7.5%. Shorter-term bonds, which are less sensitive, benefited a little bit less from the declining interest rate environment, still up a healthy 4%. Long-term returns, very healthy for the U.S. market. You can see over the trailing 3, 5, and 10 years up into the mid-teens. Still positive returns for the international and EM stocks, although they did trail U.S. High yields had a good long-term run as well, with returns in the high single digits, and even investment-grade bonds up 4 to 5% per year over the last decade. One unmistakable trend that's emerged in 2020 was the significant outperformance in the market leadership coming from the largest of the mega cap stocks. So this chart here, coming from BlackRock, breaks the S&P 500 down into buckets based on the stock size. And so we see on the left-hand side the 5 largest stocks in the market. This would be Apple, Microsoft, Amazon, Google, Facebook, on average up more than 50% for the year. You see the next 15 stocks up almost 30% on average. Moving to the subsequent 80 stocks, up 18.5%, and then bringing up the rear would be the smallest 400 of the S&P 500, up just less than 10% for the year. And you can contrast this there. We do call out on the slide S&P 500 as a whole, up 18.4%, and you see the average stock there then towards the bottom, with the S&P 500 equal weight index up 12.8% for the year. One byproduct of this mega cap, largest cap stock outperformance is that the S&P 500 has become increasingly concentrated among the largest stocks of the index. Top left chart on the slide here plots the weight in the top 10 stocks in the S&P 500 going back over the last 25 years, starting with 1996. And you can see that we closed out the year 2020 with the 10 largest stocks comprising nearly 30% of the index. This is a level unmatched, even going back to the height of the dot-com bubble, where we saw 10 largest were, call it a quarter or so of the index, and certainly a rapid rise from even 5 years ago when the 10 largest at the time were only 20% or so of the index. Bottom part of the slide shows that it's not entirely unwarranted that these stocks did have such a good run. We can see plotting here the profit share of the aggregate index coming from the 10 largest, and you did see these 10 stocks at 30% of the index did actually comprise nearly a quarter of the index's profits. And this is certainly a long way from where we saw the experience back at the height of the dot-com bubble. You look in the late 90s, early 2000, the 10 largest were contributing way less of their share of the index's profits there, roughly 20% or less at the time, when they were nearly 25 to nearly 30% of the index. Nevertheless, though, we do see, as a result of the run-up in these stocks on the right-hand side, these 10 largest stocks in aggregate do trade, call it rich or at more expensive valuations relative to the rest of the market. See the 10 largest represented by the green line trading at a forward price-to-earnings ratio of roughly 33. Contrast that with the remaining 490 stocks at roughly 20. PE is just one metric to measure value. It doesn't say whether or not these valuations are warranted. But for those of you that are more valuation conscious, we do want to remind folks that there are more valuation rich opportunities when you move out of the mega cap segment of the universe. We think there are some benefits to making sure that you are well diversified away from just a traditional cap weighted index, as many of our client portfolios are. Another storyline that has started to emerge during the fourth quarter, really later part of 2020, was an internal market rotation underway, where we did see market leadership from a factor perspective shift from growth stocks leading the way to value stocks resuming some leadership. The left-hand part of the slide here is a chart just plots 3-month rolling returns of value stocks minus that of growth stocks. And you can see that in the 3 months ending in August, you saw growth stocks absolutely trounce their value counterparts. Growth outperformed value by a little bit more than 16% during that 3-month period. An exceptional run for growth and poor performance for value. The script kind of flipped in the subsequent months there, and in the 3 months then ending in November, you did see value outperform growth by 8%, which was actually the largest outperformance over a 3-month period we'd seen in nearly 20 years for value, or going back to 2002. You can see that in some respects the experience, while not the same in scale and magnitude over the last, call it 6 months here, in terms of a significant growth run followed by a significant value outperformance, does mirror what we saw towards the height of the dot-com bubble, where you saw right at the peak growth absolutely trounced value, and that subsequently reversed, and you did see some value leadership. We don't know what the future is necessarily going to hold. BlackRock's analysis there on the right-hand side does suggest that at least historically, if you look back over nearly a 100-year period here, when you do see very strong bursts of value outperformance relative to growth in excess of 7% over a 3-month period, historically, we've at least seen over the subsequent 1-3 years that on average value has continued to outperform. We don't know if that'll hold the case, but history suggests the odds are likely that we may see that. Slide here comes from Charles Schwab. Just provides a snapshot of earnings expectations among analysts for U.S., international, developed, as well as emerging market stocks. And a very good news story here. In consensus expectations, earnings are expected to grow pretty significantly around the globe in 2021. You can see analysts expecting, with the blue bars here on the chart, earnings grow about 20% in the U.S., nearly 30% in foreign developed, and almost 35% in emerging market stocks. Again, for kind of valuation conscious investors, we see the orange bars here do give some cause for optimism on international stocks looking forward, as you see not only the stronger earnings growth projected in outside of U.S. borders, but we're able to buy international stocks at more attractive valuations relative to the U.S. counterparts, as represented by the orange bars. So some potentially a cause for cautious optimism on international stocks as we look forward. Turning now to the economy and the labor market specifically, chart on the left-hand side shows just employees on total non-farm payroll, so a measure of aggregate employment in the U.S. economy. And you can see what a ride it's been in the labor markets over the last year. So from a peak of 152 million jobs there in February, right before the economic downturn, we saw nearly 22 million jobs were shed over the course of March and April. We've, of course, seen a lot of those jobs recover. About 12 million jobs have been recovered, but we are still about, in aggregate across the economy, about 10 million jobs shy of where we were at the end of February. Chart on the right-hand side then shows just a breakdown of jobs lost, jobs recovered, and jobs still yet to be recovered, breaking down by what's called super sectors of industries. And this is a bit of I interpret this chart as a cause for optimism as we look forward into 2021, really on the grounds of, as we have a continued rollout of the vaccine, as economic lockdown restrictions are lifted, it does set the stage for many of these jobs to come roaring back and set the stage potentially for a pretty sharp rebound in growth in 2021. So we see you have on the left-hand side there of that chart, really 3 or 4 sectors accounting for the vast majority of the jobs yet to be recovered. 3 in particular do stand to benefit pretty rapidly from a continued recovery and combating of the virus. So, right, leisure and hospitality still about 3.5 million jobs shy of where we were. Think of this as restaurants, hotels, entertainment, right? All these jobs that could come back in a hurry. Next sector there, trade, transportation, utilities, still about 1 million jobs shy of where we were. This is going to be predominantly retail, airlines, things of that nature that, again, could stand to recover quickly. And then you have health and education services. And so think of this as schools, as well as kind of call it less essential doctor's offices, medical services. Again, all could come roaring back. So cause for optimism there in terms of the labor market, despite the pain felt in terms of still being 10 million jobs shy of where we were. Turning now, just we look at a snapshot of the U.S. consumer. And this is, again, I take this slide as cause for optimism of rebound and growth in 2021. And what we see on the left-hand side is two measures of personal income, both indexed relative to November of 2019 levels. And the green line shows personal income actually at the height of the economic downturn. If we look at the April figures, was up about 15% in April relative to where we were in November of 2019. And if you look even just as we look to November of 2020 versus a year ago levels, personal income in aggregate was about 5% higher than it was a year previously. Of course, a lot of this was due to the federal government's efforts in terms of direct stimulus from the checks that were sent out to all Americans back in the early part of the spring, as well as enhanced unemployment benefits as well that resulted in many on the lower end income scale actually earning more on unemployment than they had been while employed. Some of those have faded. Obviously, this still doesn't include the second round of checks that did come back out in December that are still working their way through the system in January. But what you see there on the purple line is stripping that out and the fiscal stimulus or transfer payments, as they're called in economic parlance. We saw income on a year-over-year basis actually flat in November relative to a year ago level, recovering sharply from the dip we did see in the spring. Right-hand side shows that a lot of this income actually went into savings. So U.S. consumer building up a war chest, so to speak, or a safety buffer. We saw saving rates spike to roughly 35% during the height of the economic contraction. This is probably a byproduct of consumers being cautious and building up that buffer. Also, a reality of that consumers simply didn't have anywhere to spend their money. Saving rate has certainly dissipated a little bit, but still remains at historically high levels. We look at this as, again, cause for cautious optimism that we could see a rapid rebound in growth in 2021 as progress is made in combating the virus and reopening the economy, as consumers have a built-up buffer of savings that they could be looking to deploy. Lastly, then, we'll conclude things with just a brief look at the bond markets. This is a topic we've had a lot of conversations with clients and investors about over recent months. What we plot here is, in the blue line, a measure of the yield on the broad investment grade bond market as represented by the Bloomberg Barclays U.S. Aggregate Bond Index. And you can see the trend that's really been in play more or less for the last almost 40 years at this juncture of declining interest rates. And we saw the broad investment grade market end of the year at historically low rates of, call it, 1.25%. At the same time, investors are kind of faced with this dilemma of that while yields have moved to historically low levels, we've also seen risk by one measure move to all-time highs. That's represented there by the gray line in the chart, which measures the duration of the index. And the duration is simply a measure of the sensitivity of the index to changes in interest rates. So a higher duration means that you are more sensitive to interest rates, such that if rates were to rise, you would have a more sensitive or more significant decline in the index. And so you've seen this line, the duration of the aggregate index, move from about 4 years, meaning that a 1% rise would result in a 4% loss, to nearly 6 years, representing kind of matching the all-time high we saw there in the late 70s, such that a 1% rise in rates would result in a roughly 6% loss on the index. So this chart is, it's not a great news story. You see historically low rates with historically high risk on the bond market. It's why we continue to advocate very strongly for a barbell approach to bond portfolio positioning, where we focus significantly on the shortest on very short maturity bonds that are very limited sensitivity to interest rates, slightly lower yield but slightly less sensitive, paired with a combination of high yield bonds in order to gain some income from bearing a little bit of incremental credit risk. But we really do try to shy away from bearing too much interest rate at this time, where you're just not looking to get a lot of rewards from it. So that's all we have for today. We appreciate you taking the time to listen in. If you have any questions, please don't hesitate to reach out, and we will see you next quarter.